The Credit Suisse collapsed. Credit Suisse was not some small regional lender. It was one of the world's 30 most systematically important banks. A 167 years old Swiss institution considered too big to fail. In March 2023, just days after Silicon Valley Bank collapsed in the US, Credit Suisse effectively collapsed and had to be rescued thoroughly. An emergency government orchestrated takeover by its biggest rival, UBS. Today we are going to discuss about the particular bank. So this was not a sudden problem. Unlike SVB, whole collapsed trace mainly to one specific mistake: interest rate risk. Credit Suisse's fall was not the result of years of accumulated damage. In the year lending up to 2023, Credit Suisse had been hit by a long string of scandals and losses. It suffered massive losses prior to the collapse of Orcheos Capital Management in 2021. A client whose hidden swap-based leverage blend up, it was entrenched in the collapse of Greensill Capital, a supply chain finance firm which cost the bank billion and its client significantly losses. It faced repeated executive turnovers, compliance failures, and reputational scandals over several years. Each of these individuals was damaging. Together, they built a long track record that steadily eroded trust in the bank's risk management and leadership. Why trust matters so much for a bank? Here, a core truth about banking that is case illustrates perfectly. A bank's survival depends heavily on confidence, not just a balance sheet. Bank doesn't keep all deposit money sitting in a wallet. They lend and invest most of it. That means it enough depositors and clients decide the pull their money out at the same time. Even a technically solvent bank can run out of steady cash and collapse. By late 2022, years of scandals had already made client nervous. Credit Suisse experienced significant deposit outflow and asset withdrawal well before the final crisis. A slow bleeding of confidence that makes the bank far more fragile than its headline financial number might have suggested. The spark that set it off. Then came March 2023, a moment when the broad banking world was already jittery. Just a day after Silicon Valley Bank collapse dominated headlines worldwide. Into that nervous environment came a specific spark. Credit Suisse's largest shareholders, the Saudi National Bank, publicly stated it would not provide any additional capital to the bank, citing regulatory constraints on ownership stakes. That single statement, landing it at already fearful market, was enough to trigger a dramatic collapse in Credit Suisse's stock price and a fresh wave of panic. Client and counterparties already trying to worry after SVB accelerated their withdrawals dramatically. The emergency rescue. With Credit Suisse situation deteriorating by the hours, Swiss regulators and the Swiss National Bank stepped in over a single week to prevent a full-blown collapse. The outcome: UBS, Credit Suisse's largest domestic competitor, agreed to acquire Credit Suisse in an emergency government broken deal announced before financial market reopened on Monday to avoid the chaotic market openings. A particularly controversial detail: as part of the deal, Swiss regulators wrote down a classic of Credit Suisse's bond called Additional Tier 1 AT1 bonds to zero. Even though unusual, some shareholders retained partial value in the deal. Normally, bondholders are expected to be protected ahead of shareholders in a company's collapse. This reversal shocked bond market worldwide and lead to lawsuit and renewed scrutiny of how these instruments are structured. Why this mattered globally? Credit Suisse was not just a bank, it was one of the roughly 30 banks globally designated as a global systematically important bank, meaning regulators consider its failures a genuine threat to the broad financial system. The fallout carried several lasting effects. It raised serious questions about whether too big to fail protections and modern banks regulators actually worked as intended. The 81 bonds wiped out unsettled a major concern of the bank capital market since investors had to reassess how much protection these instruments really offer. It intensified fear of a wider bank crisis in 2023, following closely on the heel of SVB and other regional bank failures in the US. It effectively ended Credit Suisse as an independent institute after 167 years, folding one of Europe's most storied banks into a single dominated Swiss banking giant, USB.